This is Ralph Sass, and this is the lecture for inventories and cost of goods sold for financial accounting. And once again, I'll probably be doing this over two approximately 15 to possibly 20-minute videos. So this is the first one. The first thing to realize is that what most of this chapter deals with is how do we determine what our inventory value is and what our cost of goods sold is. And the thing to realize is suppose that I bought 4 units of a particular product. The one I usually like to think about is gasoline, 4 gallons of gasoline. Suppose that I bought one of those gallons at $2.50, another one at $3, another one at $3.50, and another one at $4. And I sold you 1 gallon, but I don't know which one because all the gallons look alike. Okay, it's just a gallon of gasoline. Did I sell the unit that cost $2.50, and is that what's going to show up in cost of goods sold? Or did I maybe sell the one at $3? Or possibly the one at $3.50? Or maybe the one at $4? And so how do I know which unit I sold? How do I know what my value of cost of goods sold is? And related to that, what is the value of the ending inventory? And I have 3 gallons left if I sold one. But what 3 gallons and what value do I put on those? So that is the purpose of this chapter, and that's what we're trying to determine in this chapter. And what we're going to find out is that there were 4 possible ways to do this. Um, Keep in mind what happens is that retail stores, what have you, wholesalers, what have you, are buying goods. They're putting those goods onto their balance sheet as an inventory. And then ultimately, when they sell them, they're showing up as cost of goods sold. And so the purpose of this chapter and what we're trying to figure out is what value do we put in that inventory value and what value ultimately shows up then on cost of goods sold. In a perpetual inventory system, and this is kind of a review quickly of chapter 6, remember what we did. Back in chapter 6, what we did is we had 2 journal entries. Okay, ultimately we had 2 journal entries. In some cases we had 3 because we had to get it out of cost of goods sold and record the sale. But notice what happens here. When we bought the good, we put the good in inventory, so that was our debit, and our credit was to accounts payable. I'd have preferred cash just because it makes it simpler, and that puts that item into inventory. And then when we sold the item, remember from chapter 6 we had 2 journal entries. Here we're only counting the one to get it out of inventory. But notice our debit now is the cost of goods sold. Cost of goods sold is a expense type account. And then our credit is to inventory to get that particular item out of inventory. And the whole chapter predominantly deals with what value do I use for those? Okay, so the question that comes up is which unit did we sell? Okay, when identical units, and this gets back to my very first slide, have different unit costs, which one of those costs should be recorded as a sale in inventory? What dollar value do I put in there? Okay, so that's what we're trying to determine. Most companies, all companies that use some sort of a computer system have some sort of an inventory subsidiary ledger. It may look something like this, that notice it's got the item, the description, a lot of times it's where it's located. And then notice towards the bottom here, it's got the units that were purchased, it's got the date, how many units, what the cost is. It also has a column for how many were sold. And then it has a balance showing what's in inventory. And if you think about it, when you go to Lowe's or you go to some of those stores, one of the things they immediately have is you ask, do you have any in stock? They walk over to their computer and pull up that particular stock number, stock item, whatever. What are they pulling up? They're pulling up a card that looks like this. That tells them, yes, they're in stock, or no, they don't have any in stock. And a lot of times if they have none in stock, they'll know when they're coming in. But that's what they're pulling up. For small businesses, I should add, it's a very time-consuming process to get this up to date and created. But it's well worth it as far as the time spent in saving you from knowing what you have back in inventory. The first of our methods is specific identification. And this is when you specifically know which product you sold. Okay, in this case, Mead sells one generator for $1,800 cash and uses specific identification. Specific identification is frequently used in things like jewelry stores, auto dealers, what have you. And the reason they can do this is because they have an ID number. In the case of cars, it's a VIN number that specifically identifies what car they bought, how much they paid for it, and then when they sell it to you or I, they know exactly how much they sold it for. So specific identification works for those particular types of situations. It doesn't work for my gallon of gasoline example from earlier, but there are situations where you know specifically because of a model, an ID number, what have you, of the particular item you sold. Typically, jewelry stores, auto dealers, things like that, which are selling items based on VIN numbers, will have something like that and can use specific identification. Okay, notice what they're going to do, and this is a journal entry back from chapter 6. When they record the sale, they record it at the retail price, and then when they get that particular item out of inventory and into cost of goods sold, they record it at the cost, and that cost now is the specific one for that particular model number, VIN number, what have you, that was on our balance sheet. Another method, and this can be done very easily with my gas example, is an average cost method. And in this case, what you do is you determine the average cost. So in this particular case, notice what happened. They bought 5 units. The total cost was $5,600. So they take $5,600, divide it by 5, and the average per unit is $1,120. So now when they sell that unit, notice the last row there, under cost of goods sold, they sold 1 unit. What are they going to record as the cost? They're going to record the cost at $1,120. And that's going to come out of inventory. And then their inventory balance is they're going to have 4 units left at $1,120. And what's going to happen is when I purchase additional units, I'm going to go ahead and add those units, add the cost to that 4,480, and figure out a new average. So that average every time I buy some units is going to change, and that's going to be the cost I'm going to use until such time as I purchase some additional units. So average cost is the second method. So one is specific identification. Second method is average cost. The third method is FIFO. And FIFO is probably one of the most widely used today, and it stands for first in, first out. And this really fits, hopefully, if you're rotating your stock. This is going to match then pretty much what you're doing on the showroom floor or what have you. What you assume in this case is the first one that came into your store is the first one sold. So in this particular case, if you look, the first ones in on this particular product were the 2 units purchased on January 5th at $1,000. So since those two were the first ones in, that one, when I sold one, is going to be the first one out. Okay, so I will have my cost of goods sold will be the 1 unit at $1,000. And then notice what happens on the far right, in the very last row there. Because I sold one, I only have 1 left at $1,000. And I have 3 units left at $1,200. So what's going to happen in this particular, in this case, is my inventory value is now $4,600. The next unit I sell is going to be that next unit that's left from that January 5th purchase at $1,000. And then I'll have 3 units left at $1,200 each. And then if I would sell 1 more, now they're going to start coming out of that February 5th purchase. Okay, so what's going to happen is the first ones in are the first ones out, and I just kind of keep using the values as I sell the units. Okay, and if I bought some more units on March 5th or March 10th or what have you, until I sold those 5 units that I already owned, the 2 from January 5th and the 3 from February 5th, I would not go ahead and record any of those as being sold. So I have to sell the ones from January 5th first, then I'm going to sell the ones from February 5th, and then I'm going to assume that I'm going to sell the ones that I bought on March 5th or what have you. So the first ones that came in are the first ones out. That is our third method. And our last method is what we call LIFO, which is the last in, first out. This was widely used back in the 80s and 70s. It's rather rare to use this one today. And this one assumes that the last units that came in are the first ones out. This is, I mean, if you think about it from rotating stock, you would not be rotating stock in this case. And in this case, notice what happens when I sold that one unit. The last one that came in is the first one sold. So the one that was sold was $1,200. And notice then that I have in that last row there for my total left in inventory, I have 2 units left at $1,000 and 2 units left at $1,200 for a total of $4,400. So in this case, I am assuming that the last ones that came in are the first ones out. So the next unit I sell is going to be at $1,200. And the next unit I sell after that will be $1,200. And only then, after I've sold all 3 of those, will I go back to that January 5th purchase. So in this case, the last ones in are the first ones out. A couple of quick notes, and this is kind of a summary of the all 4 methods. Okay, and the one I want to go to is FIFO and LIFO. And the reason is, and I want to look at the comments. And under FIFO, notice under the comments section, the last comment, may overstate income during periods of rising prices and may increase income taxes due. What happens is when prices are going up really fast, you're using all your old costs and not your current costs. So your income is going to be higher and your income tax bill is going to be higher. That's why they did not use FIFO a lot back in the 70s and 80s, because prices were going up rather quickly, about 1%. At its peak, they were going up about 1% a month. Okay, so what they did then back in the 80s is use LIFO, because notice LIFO, the comment. It's the most conservative method during periods of rising prices and often results in lower income tax, because what you're showing as cost of goods sold is those most recent items that were purchased. Those most recent items that were purchased at the highest price. So during the 70s and 80s, a lot of companies were using LIFO. Today, almost everybody uses FIFO, or possibly average cost. Specific identification is most likely used for unique products. One other quick kind of note about these various methods: if prices are the same, if prices aren't changing, okay, they're all going to give you the same cost of goods sold and the same inventory values. It's only when prices are changing that you're going to get different cost of goods sold. And keep in mind, if you have different cost of goods sold, you're also going to have different income values. And then you're also going to have different inventory values. There is a principle of consistency that we need to be aware of. Once a company has adopted a particular accounting method, it needs to follow that method consistently rather than switch from one method to the next every year. Can you switch? Yes. Can you switch every year? And the answer is no, your auditors will not let you. But was it okay for companies back in the 70s to use LIFO? Yes. Was it okay for them to switch to use FIFO today? And the answer is yes. If we get at a point in the next 20 years or what have you, where inflation is going up again, and they want to switch back to LIFO, could they? Surely. Okay. You're not locked in, but you can't switch from year to year. I mean, and you need to be prepared to tell your auditors why you wanted to switch and why that made sense. Just-in-time inventories also reduces the need to worry about inventory methods, because if you use just-in-time, if the goods are just coming in and you're shipping them out at the same time or very shortly thereafter, the price will not have a chance to change. And once again, FIFO, LIFO, and average will all give you, if not exactly the same, very close to the same cost of goods sold and inventory values. So in the event you're using just-in-time inventory methods, all 3 methods are going to be approximately the same. To the extent prices are not changing, the cost of goods sold and inventory are going to be the same. So the only time where you're going to come up with different numbers for inventory, cost of goods sold, what have you, is where prices are changing. And that, keep in mind, those changes could be increases or they could be decreases. You do need to, even if you're maintaining a perpetual inventory system, from time to time, usually at least once a year, you will take a physical inventory and then you will adjust your records to reflect that physical inventory. The reason why you have to do that is you do get shrinkage, things such as theft, breakage, what have you. Sometimes your book even uses the term um, normal inventory shrinkage. I kind of hate that term because it kind of assumes that, oh, we're going to lose some and some are going to get broken and some are going to get stolen. But we have to be realistic and realize that those things do occur. From time to time, and we do need to write down our inventory. And when we write down inventory, it'll usually be for one of two reasons. One is that it becomes obsolete. And since it's obsolete, it's unfair for us to show that old value on our balance sheet because it's no longer worth that. Suppose I have some flip phones still in my inventory. I may have paid $500 for them or what have you and expected to sell them for $700. Obviously today with smartphones and all the rest, they're obsolete. Nobody's going to really come in and buy those. Is it fair that I still show those on my balance sheet at $500? And the answer is no. So from time to time, I do have to reduce my inventory values for obsolescence. Sometimes I also need to reduce it to what we call the lower of cost or market. If prices are going down and I still have those items in inventory, I do from time to time need to reduce those prices. And notice how we adjust those. We adjust those to the lower of the historical cost or the current replacement cost, which is the market value. So if I bought something for $100 and today to replace those, it's only $50, I may, emphasis on the word may, need to mark those down from $100 to $50 because they're no longer worth that $100 that I paid for them. This is a particular way in which it is done. Notice what happened. This company owned Downhill Skis. They use FIFO. And notice what happened. Okay. The downhill skis, the ski equipment, its cost was 16 grand. Its market value is now 18 grand. What's going to show up on our balance sheet? It's going to be that 16 grand. Okay, it's going to be that 16 grand. But notice when we take a look at the cross-country skis, one quick note about those downhill skis, we never, ever, ever, ever mark the value up to the market value. If we have the cost and the cost goes up, we leave them at cost. But notice what happened to those cross-country skis. Okay. Notice what on an individual item basis, they took those items and marked them down to 3,000. Why? Because even though they bought them for 4,000, what are they current on their balance sheet? What are they currently what could they currently be purchased for? Only 3 grand. So in that case, they marked them down. Okay. You can see here there are some different ways to do that. You can do it based upon, individual items or a category, what have you, but you can mark items down in the event they've gone down in price. You cannot mark items up. Last item I'm going to talk about on this is when does it show up on your balance sheet? And here the important point is, what does the purchase order say? If it says free on board, suppose you sent some items and on December 31st, they're on a truck someplace in the middle of Kansas. The question is are they on my balance sheet or are they on my supplier's balance sheet? And it all depends upon what the invoice says. If it says free on board shipping point, and usually instead of shipping point, it says free on board with a city name in there, title passes to the buyer at the point of shipment. If that's the case, let's suppose they're shipping goods to me. They're on a truck in the middle of Kansas. I'm waiting for them here in Virginia. Even though they haven't gotten here yet, because they're mine at the shipping point, let's suppose San Francisco, I have to include that the value of those goods on that truck on my balance sheet. If, on the other hand, it says free on board destination, they're not mine until they get to my dock. In that case, title passes to the buyer at the point of destination. In that case, that truck that's sitting in Kansas on December 31st is not included in my inventory. So we need to pay attention to when those goods are transferred, when actual title transfers, and usually it'll be mentioned on the purchase order or what have you. That concludes the first part of the lecture for this chapter, and I'll conclude the second part in the next video. Thank you.